Imagine waking up on a Monday morning and realizing you never have to sit through another morning commute, never have to clock into a 9 to 5, and never have to wait for someone else to approve your vacation days. For most people, that kind of freedom feels like a fantasy reserved for the wealthy, the lucky, or those who inherit millions. But what if I told you that achieving financial freedom, the ability to retire early and live life on your own terms, could be as simple as owning just 3 rental properties? Now, I know that sounds almost too good to be true. After all, we've been told our whole lives that retiring comfortably requires decades of grinding, saving up millions in retirement accounts. Now, everything makes a good investment, and hoping the stock market doesn't crash the year you plan to stop working. But here's the thing, real estate can flip that script entirely. Instead of relying on a nest egg, you slowly chip away at investment. Rental properties provide you with something much more powerful: consistent, recurring cash flow that grows over time. And the truth is, you don't need 50 properties or even 10. You can build a retirement plan around just 3. Think about it. Each rental property you own generates income every single month, whether you're working or not. That income pays down your mortgage, covers expenses, and leaves you with profit. Over time, rents rise while your debt shrinks. And suddenly, what seemed like a small side investment becomes the very foundation of financial independence. Now, I'm not saying this is a get-rich-quick scheme or that it happens overnight. It requires strategy, patience, and the right approach. But the beauty of real estate is that it's a system that rewards consistency. You can start with 1 property, learn the ropes, and scale that into 2, then 3. Before you know it, investment. You're looking at a level of passive income that rivals what many people earn from decades in a traditional career. So in this speech, I'm going to break down exactly how you can retire early with just 3 rental properties. I'll share the 4 most important principles that make this strategy work. And by the end, you'll see that early retirement doesn't have to be a dream. It can be a realistic plan if you take the right steps. ChatGPT said when it comes to retiring early with just 3 rental properties, the single most important factor that determines whether you succeed or fail is the very first decision you make the kind of property you buy. Too many new investors get excited by the idea of real estate as a ticket to financial freedom, but then make the mistake of picking the wrong property. They might fall in love with a home that looks beautiful but doesn't make money, or they buy in a location where demand is inconsistent, or they overestimate how much rent they can actually charge. The truth is, everything makes a good investment. No matter how disciplined you are about saving, no matter how smart you are about financing, none of it will matter if you don't start by choosing properties that put money in your pocket from day one. Investment. Smart property selection is not about speculation, hoping the value goes up in 5 or 10 years. That's gambling. Instead, it's about running the numbers and making sure the property pays for itself every single month while leaving you with a positive return. This means looking at cash flow first, appreciation second. A good rental should generate more in rent than it costs you in mortgage, taxes, insurance, and maintenance. If it doesn't, you're basically subsidizing your tenants, and that defeats the purpose of building a retirement plan around real estate. Now, what makes a property smart for this kind of plan? The first factor is location. You don't necessarily need to buy in the most expensive city or the fanciest neighborhood. In fact, you often get better returns in markets that are more affordable, but still have strong job growth, good schools, and steady demand for housing. For example, a property in a mid-tier city where rents are rising steadily and people are moving in can often outperform a property in a glamorous coastal market where prices are sky high, but rents don't cover the mortgage. You want to think like a business owner. Where will your rental income be reliable and consistent? And where can you expect steady appreciation over the long term? Another key factor is tenant demand. You need to buy properties that people actually want to live in, and not just today, but 5, 10, even 20 years from now. That means looking at the basics: safe neighborhoods, access to schools, grocery stores, public transportation, and jobs. If your property is in an area where tenants are constantly moving out or struggling to pay rent, you'll face higher vacancies, more turnover, and less predictable cash flow. On the other hand, if you select properties in areas where demand is steady, you'll be able to keep them occupied with quality tenants who treat the place with respect and pay rent on time. It's also important to understand the size and type of property that works best for this strategy. Many new investors are drawn to big single-family homes, but often modest 3-bedroom houses or small multi-family units generate better returns. Why? Because they're affordable to buy, they appeal to a wide range of renters, and they're easier to maintain. A smaller investment, practical property in a good area will almost always outperform a flashy house in a location that's hit or miss. Numbers, of course, are at the heart of every smart property decision. This means carefully analyzing rental comps in the area to see what similar properties are actually renting for, not what you hope they'll rent for. It means calculating your expenses realistically, including not just the mortgage, but also property management fees if you don't plan to manage it yourself, repairs, vacancies, and insurance. A lot of investors underestimate these costs and then wonder why they aren't making money. Smart investors know that if the numbers don't work on paper, they won't magically work in reality. Investment. Starting with the right property also gives you leverage down the road. When you buy a rental that cash flows positively, you're building equity every month as your tenants pay down your mortgage. Over time, investment. The equity can be tapped through refinancing or using a home equity line of credit, allowing you to purchase the next property. This is how you grow from 1 property to 2, and then to 3. But if you buy a property that barely breaks even or worse, loses money every month, you'll be stuck. You won't have the financial breathing room to expand your portfolio. There's also a psychological element to smart property selection. When your very first investment is a winner, it generates cash flow, it appreciates steadily, and it feels manageable. You build confidence. That confidence is what pushes you to buy the second property and then the third. But if your first property is a money pit, you'll feel overwhelmed, stressed, and hesitant to keep going. That's why starting with the right one is so critical. So when we talk about retiring early with just 3 rental properties, what we're really talking about is multiplying one smart decision 3 times. Investment. Each property has to be chosen with intention, with numbers that make sense, and with a focus on long-term stability rather than short-term speculation. The difference between buying and, rental and a great rental is the difference between retiring early and struggling for years. It may take time to find the right property, and that's fine. Patience at this stage pays off for decades. Once you get that foundation, right, everything else, the financing, the cash flow, the debt paydown falls into place naturally. One of the biggest misconceptions about real estate investing is that you need to have hundreds of thousands of dollars sitting in the bank before you can even get started. People imagine that buying multiple properties requires enormous upfront cash, and so they never take the first step, investment. But the reality is that real estate is one of the few investments where you don't need to pay for the full value upfront. Instead, investment, you can leverage financing to control large assets with relatively little money out of pocket. And if you do it strategically, you can scale from 1 property to 3 in a surprisingly short period of time. This principle of leverage is what makes the dream of retiring early with just 3 rental properties actually possible. Think about it this way. If you wanted to buy a $300,000 rental property outright, you'd need all $300,000 in cash. For most people, that's not realistic. But with financing, you may only need 20% down, around $60,000 to own and control the exact same asset. Invest. The tenants who live in that property are effectively paying off the mortgage for you while you collect the cash flow and benefit from appreciation. That means you're using someone else's money to build wealth. Investment. This is the essence of leverage, putting in a smaller amount of your own capital to gain control over a much larger income producing asset. But leveraging financing doesn't just stop at buying the first property. The real power comes in how you use it to scale efficiently. Once your first rental is generating consistent cash flow and building equity, you can tap into that equity to fund your next purchase. For example, investment. If your property appreciates in value over several years, you can refinance, pull out some of the increased equity, and use it as the down payment for property number 2. In this way, investment. Each property becomes a stepping stone to the next, and you don't need to constantly save massive amounts of cash out of your own pocket. Scaling efficiently also means being intentional with your debt. Not all financing is created equal, and smart investors understand the difference between good debt and bad debt. Good debt is money you borrow to acquire an asset that pays you more than it costs you to hold. If your mortgage costs $500 a month, but your rental brings in $200, that's a win. Bad debt, on the other hand, is money you borrow for something that doesn't generate income or loses value over time, like expensive cars or consumer purchases. When you focus on acquiring good debt in the form of well-financed rental properties, investment, you're essentially building a machine that generates wealth while someone else pays down your obligations. Another important part of leveraging financing is being disciplined about how much debt you take on at once. The temptation is to overextend, to buy too many properties too quickly, thinking you'll get rich faster. But over-leverage is one of the fastest ways to burn out and lose everything if the market shifts or vacancies hit. That's why the strategy of retiring early with just 3 rental properties is so effective. You don't need 20 properties, which can make you vulnerable if something goes wrong. With 3, you can stay conservative, keep your debt manageable, and still generate enough income to reach financial freedom. Scaling also requires building relationships with lenders who understand investment properties. Traditional banks can sometimes be rigid, but local credit unions, portfolio lenders, and even private money lenders often provide more flexible options for investors. By keeping your credit strong, documenting your rental income, and maintaining solid financial habits, investment, you make yourself a more attractive borrower, which opens the door to more opportunities. The more you prove yourself with one successful property, the easier it becomes to secure financing for the next investment. It's also worth mentioning that leveraging financing isn't only about mortgages. Creative strategies like house hacking can speed up the process dramatically. For example, buying a small multi-family property, living in one unit, and renting out the others allows you to qualify for an owner-occupied loan with a lower down payment. Meanwhile, your tenants cover most or all of your living expenses, investment, freeing up more of your own money to save for the next property. This kind of creative leveraging accelerates your path to scaling without taking on unnecessary risk. Once you've got 2 or 3 properties working for you, the efficiency of leverage becomes even more clear. At that point, you're no longer just an individual trying to save money from a paycheck. Investment. You've created a system where each property is funding the next, and your tenants are essentially financing your retirement. Over time, rents increase, your mortgages shrink, and your equity grows larger. Investment, the compounding effect of this system is what makes retiring early with only 3 properties not just a possibility, but a practical plan. Of course, the key to all of this is discipline. Financing is a powerful tool, investment, but it can just as easily destroy you if you use it recklessly. That's why smart investors are patient. They run the numbers carefully, and they never buy a property unless the deal makes sense from day one. They don't bank on appreciation or gamble that rents will skyrocket. They make sure the property works with today's numbers, and then they let leverage and time do the rest. Investment. When you understand how to use financing strategically, you no longer see real estate as something only the wealthy can afford. Instead, you see it for what it really is. A pathway where ordinary people can acquire extraordinary wealth by using other people's money wisely. 3 well-chosen, well-financed rental properties can generate the income you need to walk away from a traditional job and retire early. The secret isn't luck. It's leverage combined with patience and smart scaling. When people talk about retiring early with rental properties, they often focus on appreciation, the idea that the value of your property will increase over time. And while that can certainly help build wealth, appreciation alone won't pay your bills every month. The real magic of real estate lies in 2 forces working together: positive cash flow and debt paydown. This combination is what transforms an ordinary investment into a reliable income stream that grows stronger the longer you hold on to it. Understanding how these 2 forces work together is the secret to making just 3 properties enough to support an early retirement. Let's start with cash flow. Investment. Cash flow is simply the money left over after you collect rent and pay all your expenses: the mortgage, property taxes, insurance, repairs, and maybe a property manager if you're not managing it yourself. If you bring in $2,000 in rent each month and your total expenses come to $1,500, that leaves you with $500 in positive cash flow. That $500 is profit, money that goes straight into your pocket every single month. Whether you're at work, on vacation, or sleeping, multiply that across 3 properties, and suddenly you're looking at $1,500 a month in income without lifting a finger. That's $18,000 in a year, enough to cover a car payment, groceries, or even travel. And that's just the beginning, because cash flow has a tendency to grow over time. Why does it grow? Because rents tend to rise while your biggest expense, your mortgage payment, stays fixed. Imagine locking in a 30-year loan today. 10 years from now, the amount you owe the bank each month is the same, but the rent you can charge will likely be much higher thanks to inflation and rising demand for housing. That means your cash flow gets stronger every year, even though your workload doesn't increase. This is why real estate is such a powerful retirement tool. It rewards patience with bigger and bigger paychecks the longer you hold your properties. But cash flow is only half the story. The other half is debt pay down, a good investment. And this is where tenants essentially build your wealth for you. Every month that your tenant pays rent, part of that money goes toward your mortgage. At first, a lot of it goes to interest, but as the years go by, investment. More and more of that payment chips away at the principal balance. By the time you've owned the property for 15 or 20 years, investment. A huge portion of the loan is gone, and you didn't have to make those payments out of your own pocket. Your tenants did it for you. Investment. This gradual elimination of debt is like a forced savings account that grows in the background without you even thinking about it. With each payment, you build equity, the difference between what the property is worth and what you still owe on it. So while you're collecting cash flow month after month, you're also watching your debt shrink. Investment, which increases your net worth. By the time the mortgage is fully paid off, all of the rent becomes pure profit. Imagine 3 properties with no mortgages. That could easily translate to several $1,000s a month in income, enough to fund a comfortable retirement without ever touching your savings. What makes this even more powerful is the compounding effect of cash flow and debt pay down working together. Let's say you use the cash flow from your first property to help save for the down payment on your second. At the same time, your tenants are paying down the loan on that first property, building equity that you might later tap into for another purchase. This creates a cycle where your investments feed into each other. Investment, accelerating your path to 3 properties and beyond. The beauty is that you don't have to work harder or longer to make this happen. Time and consistency do the heavy lifting. Of course, the system only works if you start with properties that actually generate positive cash flow. If you buy a rental that barely breaks even, or worse, loses money each month, you're not only missing out on income, you're also stuck covering part of the mortgage yourself. That defeats the entire purpose of financial freedom. That's why it's so important to run the numbers carefully before you buy. Make sure that after all expenses, you're left with money in your pocket. Even if the cash flow is modest at first, it will grow. And combined with debt paydown, it can transform your financial life. Another often overlooked benefit of this system is the stability it provides. Stocks and other investments can swing wildly in value, and you have no control over whether they go up or down. With rental properties, your income is far more predictable. People will always need a place to live, and as long as you buy in the right markets, demand for rentals tends to be steady. This makes cash flow and debt paydown a safer investment, more dependable foundation for retirement planning than relying on assets that fluctuate with the market. Think about what this looks like after 20 or 30 years. Not only do you have 3 properties that are completely paid off, but you also have decades of rising rents behind you. Instead of working for money, your properties are working for you, producing a reliable stream of income while also representing fully owned, appreciating assets that you can pass down to your family. That's the kind of security and freedom most people dream of. And it's entirely possible with just 3 rentals if you focus on cash flow and debt paydown from the very beginning. When people imagine retiring early with rental properties, investment, they often focus on the exciting parts, collecting rent, watching values rise, and enjoying the freedom that comes with passive income. But the reality is that long-term success in real estate doesn't just depend on buying the right properties or using financing smartly. It depends on building systems that make your portfolio sustainable for decades. Without a plan for management, maintenance, and resilience against economic shifts, even 3 properties can feel overwhelming. On the other hand, if you approach them with a long-term mindset, investment, those same 3 properties can provide steady, reliable support for the rest of your life. The first piece of long-term sustainability is property management. When you're just starting out, it might make sense to manage the property yourself. You save money by handling tenant screening, rent collection, and maintenance calls. But as you add more properties, your time becomes more valuable. Investment and self managing can quickly turn into a second job. The key is to build a system that doesn't require you to be on call 24/7. That's where property managers come in. Investment. A good property management company will handle day-to-day operations for a small percentage of your rental income, freeing you to focus on the bigger picture. If your goal is early retirement, you don't want to replace one job with another. By delegating the management, you ensure that your income is truly passive, not just another form of active work disguised as investing. Another crucial part of sustainability is accounting for maintenance and repairs. Too many investors only look at their mortgage and insurance when running the numbers, forgetting that houses are physical assets that wear down over time. Roofs need replacing, plumbing breaks, appliances fail. If you don't budget for these inevitable expenses, investment, you'll find yourself scrambling when something goes wrong and your cash flow will vanish. Smart investors set aside a portion of their rental income every month into a reserve fund dedicated to repairs and capital expenditures. That way, investment, when a tenant calls about a leaking water heater or the HVAC unit needs replacement, you're not stressed. You simply dip into the fund and take care of it. This not only keeps your tenants happy and your property in good shape, but also protects your long-term cash flow. Sustainability also means preparing for vacancies. No matter how great your properties are, investment, there will be times when tenants move out. If you've built your retirement plan around the assumption of 100% occupancy forever, you're setting yourself up for disappointment. Investment, a realistic plan factors in a vacancy rate, maybe 1 month per year where the unit sits empty. This conservative approach ensures you're not blindsided when it happens. And over time, if you're diligent about keeping your properties desirable, your actual vacancy rate may be lower, which just becomes a bonus. Another factor that often gets overlooked is the broader economic environment. Housing markets go through cycles. Rents may dip temporarily, property values might stagnate, or interest rates could rise. If your entire strategy relies on everything always going perfectly, you're vulnerable. Investment, sustainability comes from building in safety margins, buying properties that cash flow even at conservative rent estimates, avoiding over leveraging with too much debt, and maintaining healthy reserves. This way, investment. Even if the economy slows down, your properties remain profitable and you can ride out the storm. Remember, you don't need explosive growth to retire early with 3 rentals. You just need steady, reliable income that survives the ups and downs. Planning for sustainability also involves thinking about your own time horizon. At some point, investment, you may not want to be as actively involved in your investments as you are in your 30s or 40s. Maybe you'll want to travel more, spend time with family, or simply relax. Investment. By putting systems in place now, professional management, automated rent collection, streamlined accounting, you're setting yourself up for a future where your properties take care of you without demanding constant oversight. Think of it as building a business that runs without the owner. That's the difference between being a landlord and being a true investor. Taxes are another piece of the long-term sustainability puzzle. Rental income is taxed differently than a traditional paycheck, and real estate comes with unique deductions: depreciation, mortgage interest, property taxes, and more. By understanding how to structure your investments and working with a knowledgeable tax professional, you can legally minimize your tax liability and keep more of your rental income. Over a period of decades, smart tax planning can make the difference between barely scraping by and living comfortably in retirement. Lastly, sustainability means protecting your assets. As your net worth grows, so does your exposure to risk. Accidents happen, tenants sue, or unexpected disasters strike. Having the right insurance, but not just basic property coverage, but also liability insurance and possibly even forming an LLC for legal protection, ensures that one mistake or accident doesn't wipe out everything you've worked for. In investment, this is about peace of mind. You don't want to spend your retirement worrying about what might go wrong. You want to enjoy the freedom your properties provide. When you put all of these systems together: management, maintenance planning, reserves, vacancy allowances, conservative financing, tax strategies, and asset protection, you create a portfolio that isn't just profitable in the short term, but durable for decades. That's the real key to retiring early with just 3 rental properties. It's not about chasing the biggest returns or trying to build an empire. investment. It's about creating a foundation of stability that will support you year after year, no matter what life throws your way. With that kind of sustainability in place, you can wake up every morning knowing that your future is secure, your income is steady, and your freedom is permanent.